Hey, good afternoon, everybody. My name is Brent Moore. It's time for managing an options portfolio. And today I've got a strategy for you I think you're going to find interesting that you may or may not have heard of. But we'll go through some examples on that, and then we'll also look at our options portfolio and discuss some management decisions in various positions in that options portfolio. But I'm glad you're here, taking some time out of your day to join me. I appreciate that. I also appreciate Connie Hill, who's here to support me in the chat. Everything I go through today, Connie's going to be very familiar with. I've been working with Connie for over 2 decades now, and she's very knowledgeable in this stuff. And so feel free to ask questions. Between Connie and myself, we'll do our best to get your questions answered. So, all right. Hey, before we get too far into this, though, let me just mention a few things. One, options do carry a high level of risk and are not suitable for all investors. Two, short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the information today, the material today is intended for general, informational, and educational purposes only. It's not a recommendation. We'll go through individual stocks, options trades. They're not recommendations. The paper money software application is provided for educational purposes only. And Schwab does not recommend the use of technical analysis as a sole means of investment research. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. There we go. Let's head on over to the Thinkorswim desktop software. These are the markets. Not much action today in the S&P 500, at least on the index-wide level. We're up less than 0.2%. The strategy I want to talk about today is an income strategy. When we talk about option strategies, generally we can break them down into three goals, so to speak. The first one is speculation. Hey, you think a stock's going to go up or down or whatever, you're speculating on that stock price. That's the main goal of it. Another possibility with options and managing options is using hedging strategies, using strategies that help to offset potential losses in another part of your portfolio. It's a broader portfolio strategy. You're not really doing it so much to make money on the specific strategy that you're doing, but to help make up for a loss in another part of a portfolio or help diminish a loss in another part of a portfolio. That's hedging. The third main category we talk about with options is income strategies. What we're going to be talking today, the wheel strategy. Wheel is an income-oriented strategy here. And they call it a wheel strategy because it's done in cycles, repeatable cycles. It's not super complex, but it does require some management. So what is the wheel strategy? The wheel strategy is where we are going to sell a cash secured put. Okay, that's the first thing. Sell a cash secured put. I'm not going to write out cash secured, but I'm just going to write sell a put. Okay, potentially buying those shares through assignment. Now, as I mentioned before, you don't have to go all the way to expiration to get assigned, but if you do, that's fine. The goal is you end up buying shares. Now, maybe it doesn't get assigned. And if you sell a put and it doesn't get assigned, you bring in income. Okay, income, great. If it does get assigned, then you end up buying the stock. And then you're going to do something with that stock. Then what you'll do is after you've bought the stock, you then sell a covered call on that stock. And then when you sell a covered call on that stock, then you have two choices. Two things can happen. One, you don't get assigned, or two, you do get assigned. If you do get assigned and called out, you end up selling the stock, and then you can repeat the process and go back to selling the put. Okay, that's an income strategy, though. Okay, so when you sell a covered call, you bring in income. So let's kind of think about this. You sell a put to start, and let's say the stock stays above the strike price and you don't get assigned. Okay. Then what you're going to do is you're probably going to sell another put. Okay. Let's say this time the stock goes down and you get assigned. You then buy a stock. Okay. Then you buy stock. And what you do is you sell a call. And let's say the stock does not get assigned. It doesn't go above your strike price, and it doesn't have to go technically above your strike price to get assigned. Then what you're going to do, you'll sell another call. Okay. And let's say the stock goes up and you get called out. And then what you're going to do it sells the stock. And you end up selling a put at that point, and you've started the process over again. Okay. So that's why they call it the wheel strategy. It's just a circular motion. Sell put, sell call, sell put, sell call. Now, that may make it sound super easy. There's times, though, when you're put into tough situations. For example, let's say you sell a put on a poor stock. A stock goes down and down and down. You sell the put and you buy the stock. You end up in a situation where if you sell a call, you're agreeing to buy the stock, agreeing to sell the stock at a lower price than what you sold the put for in the first place, or what you bought the stock for in the first place. It can be tricky if the stock moves a lot. So for that reason, this is more of a neutral, maybe a little bit of a bullish strategy. Okay, so that's the basics of what the wheel strategy is. We'll go to individual examples of that in just a minute. But remember, neutral, moderately bullish. The wheel starts with the stock decision, though, not the premium decision. You don't do this strategy, and this is true with other income strategies, by the way, everybody. When you're selling a call or selling a put, you don't start necessarily with this juicy premium that you see. You got to find a decent stock, because if you don't find a decent stock and the stock just goes down and down and down, you're in a losing situation there, and it's tough to recover there. Remember, when you sell the put up front, put up front, you're obligating yourself to buy 100 shares of stock. First of all, you need the cash to do so. So there's a good chance you're probably not going to do this strategy on a stock that's, a $500 stock. And there's a number of those out there. I mean, unless you're prepared to spend $50,000 buying the stock. Okay. So that's the key. You got to find a good stock to start with. So how do you find a good stock? Well, we may use technical analysis. We may use fundamental analysis. But the question that you have to ask yourself is, would I be comfortable owning the stock at this price if it moves against me? So if we're going to start out selling a put, am I willing to own the stock? Okay. So let me give you a couple examples here. Let's do this. I'm going to pull up Broadcom. Here's AVGO. It's gone down. It's kind of leveled out maybe a little bit lately. So I'm going to say we're kind of in this more of a neutralish standpoint. Now, long term, where's this going? I don't know. But if you're bullish, maybe you would consider it. Now, we could use some fundamental analysis if you wanted to. Let me go to the fundamentals page. And you can go and maybe you check out third party. These aren't recommendations, but third party analyst estimates. Some people do that. Some people will go and look at financial information, our earnings increasing, sales, cash flow increasing year to year. Those would be fundamental decisions. We don't talk about fundamental analysis a lot in this webcast because typically with options decisions, they're shorter term decisions, and shorter term decisions, maybe we're a little less focused on the fundamentals of the stock. But in this case, even though the initial trade, the short put, is a shorter term decision, we're planning on being involved in this stock for a longer period of time, and the biggest risk is the stock goes down a long ways on us. So maybe fundamentals become involved. But if I'm going to sell that put, where am I going to sell it at? Well, there's a couple ways of thinking about it. One way from a technical standpoint is maybe you find a support level. I'm going to call this a support level right there. Okay. We're going to call that a support level. Maybe I look to sell a put down here. Okay. And then if the stock happens to dip down here, maybe that's a buying opportunity. But if the stock continues to go sideways, well, we'll sell a put again. Or if the stock goes up a little bit, maybe we'll sell a put again. But the initial selling position to sell a put may be a technical analysis decision of selling that put where support is. The other way you can kind of consider it is you can look at from a more probability-based estimate. Okay, so I have on my option chain here, I have a delta. Now I could just as easily put on here a probability in the money, and that's probably going to be ballpark figure relatively close to delta. Actually, this differs a little bit more than it often does, but that's kind of a way to think of it. So sometimes we'll use delta as a probability of it being in the money. And if we want to minimize the probability of it being in the money, then maybe we go to something with a lower delta on it or a lower probability of being in the money. The consequence of going to the lower probability is the premiums are lower. But in any case, you can kind of see that. Now, if I look down here to where our support is, around 365 maybe, I can look down here. Let me get a few more strikes on there. And we can look down here and we can kind of consider this. If we look at 365 and we were to sell this roughly here, we may be able to get something more towards the mid price here. But probability in the money, roughly 1 in 3, maybe 30%, somewhere in there. Okay. These are just estimates. Okay. These are just estimates, not promises here. But one thing I would consider on the short put aspect of this is what percent of the stock price or that you're going to be buying. You're going to be buying this stock for $365. So this is a little bit more expensive. So it would cost us about $36,000. That's a lot of money. So maybe that's too rich for you. We'll look at another example here that's going to be a little cheaper in just a bit. But consider what percentage the premium is of what you'd be spending. Well, if it's a $365 stock purchase, then $36 would be 10%. $360 would be 1%. So that's roughly a 3% premium, 3% return just based on the premium there of that stock. Okay. Now, effectively, and this isn't a tax statement, okay? I'm not talking about tax statement, but it effectively lowers the purchase price, so to speak, of this because we're buying it for $365, but we're bringing in a credit up front of $11.20 or maybe a little bit more. And so that's going to kind of effectively lower the amount of money going out of our portfolio from 365 to 354, if I'm doing my math right. Okay, so consider that. Did you guys follow the math there? I took the strike price, I subtracted the premium from that. So that's kind of, and so you got to ask yourself, would this stock be worth buying if it were at 354 down here? Okay, right about there. Okay, so, and if the answer is yes, we may consider the strategy. If the answer is no, then we probably would not consider that strategy. But it starts with this. We'll talk about selling a covered call in the future, but the first thing we got to do is this, and do that trade. So what I'm going to do is I'm going to go to the 365. I'm going to click on the bid price, okay, and make sure your quantity. Look, I don't want to sell more. This is already an expensive ask here. I want to make sure my quantity is that. By the way, if your default quantity on options is different, I'd kind of suggest, unless you have a compelling reason not to make it 1 for options. just in case you mess up and don't change it, I'd rather you come out with a lower obligation. How do you change that? Go up to the gear in the far upper right portion of the page, go to application settings, and go to order defaults. Click on options on the left and default quantity there, 1, okay? So mine's already there. I'm going to sell this. Natural price is 11.05. I'm going to go a little bit higher than that. We'll see if we can get it in between the two. And I'm going to confirm and send. And then what I'm going to do is we're going to put this in our long stock. Actually, let's see, where should this go? Should this go in the long stock category or the short? It's a short put. So let me put in the short put category. But here's what I'm going to do. We have that trade in. Let me go to my short put category. We got AVGO. And what I'm going to do is I'm going to add a note to it. Okay. I'm going to add a note. Let me just make sure I don't have notes there right now. I kind of go back and forth on that. Let me make sure that's in there. Let me move this up here a little bit and click on OK. Now I have this notes, and then what I can do is I can add a note on here and just say, just to remind myself, wheel strategy, because I'm going to manage this differently if it's the wheel strategy versus a different strategy. In other words, some short puts, maybe I decide if it starts to go down, I don't want to be in it anymore. I want to buy it back. Well, typically with the wheel strategy, that would not be the case. Let's look at one more example here, okay? And this one is Carnival Cruise, okay? Cheaper, okay, much cheaper. So there we go. Let's do this. So question from James. What about placing AVGO buy stop to avoid? Oh, you can do that. It's just not. So the question from James is, what if we do a buy stop, okay, on the stock, I assume is what you're talking about. Okay. And is that what you're talking about, James, on the stock or on the option? I guess is the question I have for you. There's certainly other strategies we can do with that, right? I could do an order. I could do a buy limit if you want and say, this would be a buy limit on the stock and say, I only want to buy this if my stock goes down to 350 or less. Okay, that'd be a buy limit. And then that'd be buying the stock directly. That's a possibility. But a buy stop would be a price above the current price and saying, I only want to get in this if the stock goes up there. Okay, so there's a lot of different order types, but we're doing the wheel strategy today. So absolutely, you can check out some of those other strategies. Here's Carnival. Okay, lower price, right? Lower price. So it's still the question. The questions are still the same. We've got a checklist, right? We've got a checklist. Is this a stock I'm willing to own? Don't do it unless you're willing to own the stock. Okay. Do I have enough cash to take assignment on the put? Well, if we have enough cash for AVGO, we have enough cash for Carnival, probably looks like. But how much would it be? $2,600. $2,600. Okay. Roughly $2,600 to buy 100 shares of that. That's a little better than that. What was it? $30,000 or whatever it was on the other one. Okay. Is this a next question? Is this a price I'm willing to buy the stock at? Well, what's your outlook? I mean, right now, Carnival's come down, and I would suspect part of that is the price of oil, right? It's going to impact them. It impacts travel in general, but maybe, and I'm not saying this is what's going to happen, but maybe your outlook is, hey, this Iran war situation isn't going to last forever. Oil prices aren't going to stay up or go up forever. And in the long run, maybe this is a good one. You can go to the Analyze tab. You can go and you can do the same analysis that you did before, uh, and look, fundamental wise if you want. But from this standpoint, what I'm going to do here is I'm going to say, uh, maybe we've got support here. Well, that's pretty close. Maybe we've got some support down here, closer to the, what is that, $24 level. Could we sell something like a $24? And so, well, let's take a look. And again, I'm going out about a month here. You don't have to go out a month. You can go out however long you want. Let's just look. $24. Let's do the same kind of premium calculation we did. Okay. And let's do this. Okay. 24. Okay. $24. And so our probabilities are, in there. $26. What would 1% be? 1% would be 26 cents. Well, it's more than that. 2% would be 26 times 2 is 52 cents. So this is about a 2% premium on this. Remember, consider the calculation. Is it too high? Can it be too high or too low? Well, I don't know if it's too high, but if we start to see higher premiums, let's say we see something in the 4%, 5% range, it probably either means our implied volatilities are very high, or our stock price is pretty close, our strike price is pretty close to the stock price. That's if we're getting very high premiums. Okay? And so the other thing is this, is we can go and we could say, well, is it too low? Yeah, I mean, what I'd say is, for a lot of traders, they'd say if we start to get less than 1%, maybe that's not enough to make the premium worth it. It's not much of an income strategy in this case. But you do have to keep it in context. A 1% premium over 1 month's time, okay? That's very different than a 1% premium over a longer period of time there. So there's that. Okay, and I'll get to more questions here in just a sec, but let me go and I'm going to just click on it. Click on the bid price to sell the put. Okay. I'm going to go to mid price. I'm going to confirm and send, and I'm going to go here and I'm going to go to let's see, we're going to put it in this category here. We're going to send that trade. And it filled. I'm going to go to the monitor tab. I'm going to do a similar type note here. We're going to click on this. We're going to click on wheel strategy just to kind of remind us at this point that we're willing to get assigned on this. Okay, so the question is, what about adding a stop to the option leg if there's a break in support? Well, the whole purpose of this strategy is we're willing to buy it if it drops, okay? Now, maybe you change your opinion on this, but you can certainly add it, but you can manage this differently. But the whole purpose of this is, the reason why we're checking for longer term bullishness is we're willing to get in if it drops. In fact, that may not be a bad thing. This is going to be a cheaper entry for us into the trade to get in this way. Now, at some point, you may change your mind on this. You can get out, and yeah, you can add a stop if you want on there to do that. But that's kind of just for our purposes here. We're going to go and decide, hey, we're willing to buy if this drops there. Okay, so there's two of those examples on that. Now let's move on and talk about some other management here. Because like when we're looking at stock, you always have the choice. I have some different positions here. And anything where I own the stock, I could, and I have at least a multiple of 100 shares, at least 100 shares, I could possibly sell a call. Is that a possible entry into kind of a wheel strategy? Well, that's not going to be my point here today. I'm not going to add these as part of the wheel strategy, but you may consider looking at these as potential potential covered calls. Like if we look at NVIDIA here, okay, I have 100 shares of NVIDIA in this account. And you're looking at your existing portfolio and you're going, well, should I sell a call on this? Well, am I willing to sell it? At what level? Am I bullish? Am I bearish on this? Typically, if it's a longer term hold and you think it's something that it's likely to go down in the short term, maybe that's the time you sell a covered call on it, right? Maybe that's the time you sell a covered call on it. So we have a pretty good big candle here today, up 3% today. So if you think this is going up, you may not sell the covered call right now. You may wait. Let's say we go up and we hit resistance or something. We call that a resistance, and we go up and we start to bounce down. That's when typically you'll sell the covered call on that. Because if you sell the covered call at that point, what happens, and assuming you want to hold on to it longer term, okay, because you could always just sell the stock, but assuming you think it's going to go down short term, what it does is it enables you to benefit from the covered call while we're waiting for the stock to kind of recover. And then as it goes down, then we'll buy back the call if you can get it cheap, and you go on from there. So are there other positions here where we decide, hey, maybe it's gone up far enough that I'm going to, I have 100 shares that I think it's going to go down. Well, we can look at Apple or CNP. How about? Okay, let's look at these. One of the challenges is I picked NVIDIA because we don't have earnings for a little bit on that. Apple, we got earnings next Thursday, I think. Okay, I think Apple always releases on Thursday, it seems. So I think it's next Thursday. So yeah, I'd get higher premiums because implied volatilities are going to be higher right now. But do I think Apple's going down? Well, from a technical standpoint, no. I mean, it seems like we're trending up. So that's probably not what we'd be looking at here. Do we have any that don't have earnings coming up? Delta or FI? Well, let's look at Delta. Okay. Well, that's going down. Do I think it's going to bounce right here? I don't know. We could sell a call on it here. If we think it's going to bounce, then that now wouldn't be the time. Let's look at another one. This is just a short-term trade on that, on Fitbit. Okay. Let me do KHC and KMI. KHC. Okay. So we've run up. KMI. We're kind of going sideways. Could I possibly sell a call up here? Maybe. This is a resistance. So if we go up, we're certainly not trending up much. Maybe I sell a call more towards the 35 level. Are we past earnings? Earnings, 722. That's today. It's today, 20. Okay. So we'd probably get a higher premium. Let's look and see what premium we'd get. We got earnings here on this. Let's look at KMI. Again, I'm going to go out a month. Let's look at a month. And I'm going to look to sell the call. What kind of premium am I getting at the 32 strike? Oh, not the 32 strike, sorry. 34 strike. Is it worth it? 34 strike. You know what? This is where you run the calculation. Let's do the calculation we did before with puts, but we're going to do it with calls this time. We're getting about 32 cents selling it. We'd be selling it at $34. That's about a 1% return, okay, on the premium. Now, the stock's 32.5 right now, so we're also selling it at 34, which is higher than the current price is. Is that worth it? I don't know. I'm going to say no in this case primarily because we have earnings, and I'm expecting more movement on that earnings. If I go to the trade tab, we're expecting about an 80 cent move on earnings in and of itself, which if that moves up 80 cents, we're already up there. I don't know. It's a judgment call. I'm not going to do it in this case, but those are some considerations when you're selling a call. Okay. So we started with wheel strategy. Well, I want to talk about management of the wheel strategy here. Let me just kind of wrap that up. I think I mostly covered. I want to just check my talking points here, make sure that I got those. Let's go back here for a sec. Okay. So sorry for the zigzag on this, because let's say we end up buying the stock on CCL. So we own CCL stock at that point. Okay. We just sold the put on it. It's our wheel strategy. And we buy the stock. Then you're going to look to sell a call on it. Okay. You're going to look to sell a call. What strike do you pick? Well, again, we're going to do the same thing. We're going to look for potential resistance levels, as we've done already on this. So let's say the stock goes down, and we said we were buying, I think we sold the 24 put. So if the stock goes down, and we buy the stock down here. So I'm going to put BS for buy stock. I should do maybe LS for long stock, whatever you want to say. We buy the stock down here. Where do I sell a put? Sell a call? Well, I could sell it at a potential resistance level. This would be a potential resistance level right here. I can look and see what premium I'd get on this. Again, look at the percentage. If I get a 0.5% of premium, it may not be something I do. I may want to look for a lower strike price, even though it's not at a resistance level. Look, I could turn around and sell the 24 strike. And assuming the stock hasn't gone too far down, the 24 strike may give me a decent premium there. And then if I sell the stock, you may be going, well, look, I bought the stock for 24 bucks, and then I'm selling for the stock for 24 bucks. I really haven't gone anywhere. But really you have, because remember, you got a premium. You got some income when you sold the put up front. We just got that. Then if you sell the call, you're gaining income if you sell the stock, the stock there, even though the stock is at the 24. So as long as the stock is going sideways, you can sell puts and calls at the same strike all the time, as long as you're keeping significant premium here. Now, it begs the question, what if the stock goes up? Okay, we end up buying the stock. What if the stock goes up? Well, after we sold the cover call, we're going to get called out. Great. What if the stock doesn't go up? What if it goes sideways? That's great. We sell this cover call again, we bring in more income. Okay. What if the stock goes down a lot? Okay, and this is kind of going to some of the other questions originally from James, I think. What if the stock goes down a lot at that? Well, that's the risk. And that's the risk. And if at some point you're not long-term bullish or neutral, we'll say neutral to bullish, then you're not going to do the strategy. But the whole reason we're doing this strategy is long-term, we're more bullish on this in this case. But at some point you can kind of get yourself in a pickle, a little bit of a bind. Do you see how that could be? Let's say we end up buying the stock at $24, and then the stock goes down to, we'll say $21. Okay. And you go, okay, I'm going to sell a cover call. And you look at the 24 strike at the premiums, and the premiums are giving you practically nothing. That's a problem. So what do? You got to go to a lower strike. So you sell at, I don't know, a 23 or a 22 strike. Well, that's fine. You bring in a little income on that. But if you sell out, if the stock goes up and you sell out at 22, your income probably has not made up. Your income for the short put and the short call probably hasn't made up for buying the stock at 24 and selling the stock at 22. So if the stock goes down a lot, it's a losing strategy. And that happens, right? And there's a mental aspect to this too. You get in this position and you don't want to, you don't want to sell it at the lower strike. Okay. You don't want to sell it at the 21 strike or the 20 strike or whatever it is, because you're in a hole and then you're kind of admitting defeat. At some point, though, if your forecast becomes bearish, you just got to cut your losses and get out at that point. Okay. We're not there on that. Maybe we'll get there on some of these trades that we look at them. But for now, as long as it's bullish or neutral, the strategy tends to work there on that. Okay. There we go. Okay. Let's go to some other trades here. But if you have any questions, let me know on that. Let's start with calendars, diagonals, butterflies today. Okay. So I'm going to look at Bank of America. This is a diagonal spread we've done in the past. Now, something to note on this, I was noticing this earlier, it's pretty neutral right now. But our theta is technically slightly negative, basically neutral, but slightly. So time isn't helping us out on this situation. This is a diagonal. So what I would suggest is you look at the Analyze tab, the risk profile. Let me go to the right stock. Bank of America. Bank of America. Here's the current stock price. Okay, right here. And what you can see is this is the where we currently sit, this purple line. This is at expiration. So as time goes on, actually things look a little bit worse. I'm not factoring in any implied volatility here or anything like that. Just purely from the result of time, things can get a little bit worse on us. Now, if we're bullish on it, things can get better. Okay, that's great. Time not helping so much. If we're bullish, things can get better. So I guess what I would say for managing this type of trade is this. Since time isn't helping us out, it would behoove us, unless we're bullish, to get out of the trade. We have a small profit, we can get out of the trade. But if we are bullish, maybe we stick with it because we still have time. There's still 16 days on this short contract. And in this case, it's fairly bullish in terms of technical analysis, in terms of the trend. So I'm going to stick with this. But if you want to take your profits, there's certainly some justification to do so, based just purely on the time decay is not really helping us out. Now let's look at mRNA, because we're actually losing money on mRNA. What is this? This is a butterfly spread. It's a skewed butterfly. It's unbalanced. And so on this, again, I would suggest we look at, number one, the time decay element of this. What's our time decay element on this? All in all, it's positive. Okay. So time is helping us out. We should see that reflected, by the way, on the Analyze tab, mRNA. Okay. We're losing money right now. This is where we are right now. So this is a very different situation from where we were at before on the Bank of America trade. This is where we're at right now. Okay. We're currently in a losing situation. You can see that. As time progresses, this actually should get better for us. Now, if it goes way up, it can get worse, no doubt. If it goes up a little bit, things should get substantially better. And even if it goes down a little bit, the time decay element should help us on this trade. Okay? So in this case, what I would say is this, factoring all those things together, I'm going to hold on to it. We got 16 days. Once we get about a week to go, we'll look to get out of the trade probably entirely. But I think with time decay, it should only benefit us unless we just take a massive move to the upside on that. Okay. Now we do have earnings. Not exactly sure when on the 31st. So, we'll see on that, but we may get out before then anyway. So there's a couple trades that, to consider there in terms of management. The main things my point on our management of those trades was this. Consider what time is going to do for you. Okay. Consider the current status. Okay. Current status, supposed to be an R. In other words, am I making money or am I losing money? And then consider the possibilities of if it moves on us, and what our forecast is. Okay. Forecast. Because if our forecast is bullish, okay, if my forecast is bullish, but if it gets worse, if it goes bullish, I'm going to be more inclined to get out of it. If time decay is working against us, I'm going to be more inclined to get out of it. Consider those factors as you're managing not just the trades we just looked at, but really any trade. Okay, we're getting a little low on time, so let's see if we can hit up a couple others. Let's go back to short verticals. So FDX, I have FedEx. I have an iron condor here, and you're going to the 2 days to go to expiration. This was one we did last Friday in our advanced options class. Okay. If you're interested in advanced options, more options content like this, in addition to this webcast, I'd encourage you to check out our advanced options webcast. It occurs on Fridays at 2 o'clock Eastern time. Okay. This is a trade we did. We did a short-term iron condor. Typically on these iron condors, we go a little longer term on it. Not long term by any means, but more than, a week or so. This one we deliberately did short term because normally we're looking to exit these with about a week to go to expiration. But on these iron condors, we're going to manage them as two separate vertical spreads. In this case, we only got 2 days to go on expiration on each of these. So we got to get out anyway. We're going to get out anyway. Remember, short options can be assigned at any time before expiration, but the odds of your early exercise or early assignment are higher as we get closer to expiration. So all in all, this trade, we generally on iron condors, you're going to do well on one side and poorly on the other side. Not always, but sometimes usually that happens. In this case, net, we made a little bit of money on it. We weren't expecting big gains on it. It was just a short-term iron condor, but we're going to look to get out of those. And I'm going to exit those separately. So I'm going to exit these as a put vertical and then the call vertical. Doesn't matter what order you exit them in, but that's how I'm going to do that. I'm going to create that closing order. I'm going to get out of this, confirm and send that, and then I'm going to do the same thing for this side. You may be going, why do I get out of one side at a time instead of all four at once? I think you're probably going to find that you get better pricing, more easy fills if you're trying to fill a spread versus a a 2-leg spread versus a 4-leg spread. You can take it even further. You can get out of one contract at a time too. But for my purposes today, I'm going to get out of these one vertical at a time, and we're going to get out of that, and we're going to send that and exit that trade. Okay, I'm just about out. We'll look at one more trade and then get out of here. Nike. I have 30 days to go to expiration. It's an iron condor. Nike's at 42. It's still kind of in between our strikes. I'm just going to let this run. Basically, we're break even right now on Nike. We're going to let time decay do its thing. It's positive theta. So everything else being equal, that should help us out. And then I think we'll probably call it there for the day. Okay, because I'm out of time. Thank you for joining me, everybody. We talked about the wheel strategy. We'll follow up in future weeks with those trades as well as our other trades. I've got a lot of trades here. I can't get to them all and do them justice, but you know what? I appreciate you, each of you. I appreciate Connie Hill for helping me out in the chat here. And as you, coming up next, we've got trading price patterns. And so let me know, I don't know what I was going to say there. Check out that class, Trading Price Patterns. Connie, thank you very much. I appreciate you. I apologize. My chat got shut off a little while ago, so I haven't been seeing any chats you've sent in. So anyway, thank you very much for helping me out, Connie, on that. Hopefully you're able to get to some of those. But I appreciate each of you. Have a wonderful rest of the day, and we'll see you all same time next week.